Hey, so here at Wiser Wealth Management, we work with a lot of airline pilots. Being in Atlanta, obviously we have a lot of Delta pilots that are clients. I was in the Delta system at ASA for over 10 years myself, and have a lot of friends that are still flying in the Delta system. So I wanted to get this out in a video as fast as I could because we're getting probably 10, 15 phone calls a day about this new market-based cash balance plan that has been announced and what our opinion of it is. Let me explain a little bit to you how this would work. I think the R&I committee at Delta did a good job of getting information out there, but I still see in the message boards there's a lot of misinformation and a lot of fear about certain aspects of the program that really shouldn't be fear at all. First of all, you can contribute $22,500 into the Delta 401k plan. The company starting next year will be contributing 17%. So what happens if you make over $255,000 a year is you have this excess 17% that couldn't go into the plan because you hit the IRS maximum. Right now the IRS max is $66,000 if you're under 50. If you're over the age of 50, the maximum is $73,500. It's important to note that that maximum will continue most likely to increase each year. It had a pretty big jump in the last year because of inflation, but that number will keep climbing. So that number is always going to be something that you're chasing each year. What the company's offering through the union bargaining agreement was a first of a kind for pilots, a market-based cash balance plan, which means that 17%, instead of coming back to you in additional pay, that 17% would go into this plan. Now, you can't manage the money. You can't select from investment options like you can inside a 401k. Instead, that money has to be managed like a pension fund. So pensions typically are 40% stock, 60% fixed income. They have thrown out the BlackRock target date fund as a great way to start. And it doesn't mean that it would always be in the target date fund, but that's where they indicated it will start. The average cost of the target date fund is 0.14% per year. That's pretty low. Obviously not as cheap as the 401k plan, but much, much lower than if you took anything over to your brokerage link and invested on your own. So inside the market-based cash benefit plan, the advantage of doing this is tax. So if your spouse works, you're a Delta captain, you're fairly high up in the seniority list, you're probably approaching, if not into 37% or 34% margin rate. If that's the case, think about it this way. Let's assume state tax and Fed tax get combined. Let's say you're at 37%. So if you're at 37%, any dollar that you can hide from your tax return is essentially saving you 37 cents on the dollar. So if you did not do the plan and you invested that money yourself, you have to overcome a 37% loss in tax in order to do that by investing on your own. So there's a huge tax advantage. The second big advantage is there's no limit. Now, I think initially you'd probably be putting $5,000, $6,000 a year. I don't see it being big dollars going into the market-based plan. Obviously, if you're making a lot of money as a Delta pilot, then you're obviously going to be able to put more in. In fact, there's a strategy that if you want to participate in this, you could get your 22.5, or in this case, you're probably old enough to put in 30. You're getting your 30,000 into the plan as fast as possible. You're over 50, you're making good money. And then you do the after-tax contribution as well and convert that to the 401k Roth. You could front load this thing to where you get a lot of money into the market-based plan. So that is a strategy if you want to really take advantage of the tax savings. Now, you do have no control of the money once it's in there. The good news is if Delta were to file bankruptcy, the money is yours. It stays in your estate. That was not actually originally part of the program. I remember listening to the R&I podcast, and they're saying that if originally that if Delta went out of business, that you could lose the money. So that's a good change since the beginning of the talks of all this. You could have lower rate of returns. So a 40-60 portfolio probably going to give you 3 to 5% per year rate of return. A lot of people are really hung up on that. I think as an asset manager, I think that you can overcome that, knowing that that's the conservative side of your portfolio. As you get older, you're not going to be investing 100% into equities anyway. So you could carry more an aggressive approach on your 401k side and let the market-based plan be your more conservative side of the portfolio. If you're worried about market fallout, or if you're retiring soon and you think about whether or not you should contribute to the plan, Delta is basically guaranteeing that if you put in $1, you'll get at least $1 back. You're not going to be harmed by the market by investing in this. So more than likely, if you've been investing in it for 20 years, there's really no risk there of not getting at least your money back out of it in the end. And hopefully you're in the 22 to 24% bracket at that time, saving yourself a considerable amount of tax. Perhaps you've moved or transitioned to a state with no state tax as well, which could potentially help you save even more money on that front. Something else I'll note about the plan is that you could potentially roll it out. So at 59.5, you can even roll your 401k money if you wanted to. But if you did not like the allocation, you needed to do something different with the money, you could roll it to an IRA while you're still working prior to mandatory retirement at age 65. So that is an option. You can do that with your 401k now as well. They do have the option also to convert it to an annuity. I don't think there's any chance I would ever recommend any pilot do that unless you're just really bad with money and you've managed to file multiple bankruptcies, you've proven that you're bad with money, then maybe someone needs to hold your money for you and dish it out over your lifetime. But quite honestly, annuities are a great way for the salesperson to make a ton of money, and really don't see people who own annuities making much of more than anything over the long term. If you choose not to do this, then essentially your money just keeps doing what it's doing now. It spills over, it gets attached to your income. You're going to pay income tax on the money, and you might go buy boats or planes or big houses or something like that with it, and you just pay the tax. So there's nothing necessarily wrong with that. We have hundreds of Delta pilots as clients. We have comprehensive financial plans built on every single one of those families. All of you here are on great track for retirement. Some of you got to Delta later, so this is a great opportunity to keep that money tax deferred and saving more for your retirement. For you young guys and gals, this is just going to be an added benefit for retirement, but it's company match or company contribution that's going in. It's not like they're taking your own money and hiding it from you. This is actually company money that's being built for your future. And also too, look, I understand what it's like to get a first class medical. So, you're going every 6 months for that medical. There could be something that derails you and prevents you from finishing your career. If that were to happen, then having a little extra in retirement is not a bad thing. If you have to have an early exit for some reason. Essentially, I think as a general rule, just general advice, I think this is great. Most people undersave for retirement. They aren't prepared for it as well as they could be. And I think this is a great opportunity to make sure that your 17% plus as you go forward in further years actually gets put away for you for retirement. I think that whether or not you make the decision to opt in or opt out is an individual family's decision. It's really hard to give advice to any one person when I'm talking to all of you at one time. There probably may be a few exceptions where maybe you're struggling with debt, you need to get out of debt, so that's not a good idea because maybe your debt elimination plan is going to be many years. Maybe you're going to have a large mortgage in retirement. You should chip down on that instead of paying it toward the market-based cash balance plan. But the fears that I've seen about the plan in general and why people wouldn't participate, I think that the tax savings overcomes all that. Because if you're participating in this, you're making at least $255,000 a year. That's the break even. If you are in a situation where you're making $500,000 a year at Delta or more, this even becomes more of a no-brainer in my mind. Just as a reminder, we have another video we did recently for pilots in general, but there's been a lot of push from other large planning firms. I wouldn't even call them planning firms. They're probably more asset management firms to take pilots' money and invest it through the brokerage link, I encourage you not to participate in those programs. Comprehensive financial planning by the hour is really all a Delta pilot needs until retirement. You'll probably need an asset manager in retirement, but not prior to retirement. We do hourly financial planning for the airline pilot community. We've been doing that for years, ever since I was spent my time back at ASA. I started that on our R&I committee, and it saves, actually we did the math, our portfolio team here did the math. If you're a young pilot starting at Delta, you hire an RAA or creative planning, somebody like that to manage your assets inside a brokerage link, you'll end up paying them over $2 million during your time there. That's $2 million that can stay in your pocket. So focus on planning. You have a great 401k plan at Delta. The cost is very, very low, about 3 basis points or 0.03% a year. Everything you need to invest for long term is inside that plan. So focus on that. Reach out if you have any questions. Happy to help you.